So we'll now begin with a very important review on credit derivatives. So as the name suggests, credit derivatives are instruments that pass credit risk from one counterparty to the other. So we've studied derivatives before, derivatives on stocks, on bonds, on various other instruments. Primarily the movements in the values of those assets or those underlyings, that is stocks and bonds, came in because of market related events, because of stock price movement or because of interest rate movement. In credit derivatives, the movement in the underlying happens because of credit events, as we will see. So these instruments help pass the credit risk from one counterparty to the other. Why do we need credit derivatives? So a lot of times diversifying credit risk or removing credit risk or even taking exposure to credit risk may not be very simple. So if a bank has a very concentrated loan portfolio, concentrated to one industry or concentrated to one geography, then in such cases the bank may feel the need to diversify its credit risk or reduce its credit risk, because if something untowards happens in this geography or in this industry, it will be a big loss for the bank. So with the help of derivatives, banks can diversify their portfolios. A lot of times selling these loans is not very easy because the secondary market for loans is limited. So just securitizing or getting off may not be a very simple process. Easier way would be to just buy a credit default swap, as we will see. And clients many a times may not want banks to sell their loans to some other bank or to some other counterparty, because the relationship or because the business of banking is a lot about relationships, and I've borrowed from you because I have a relationship with you. So if you sell my loan to somebody else, then it may not be a very good thing for future business and for the future of the bank and the client. So for many reasons we need credit derivatives that help diversify or transfer credit risk from our portfolio or bring in credit risk into our portfolio if we so desire. The first and the most common credit derivative is referred to as the credit default swap. So there are two counterparties. Counterparty A is referred to as the protection buyer. So he can be a bank who has a concentrated loan portfolio, or another counterparty that has given somebody some credit and now has a risk of default. So protection buyer generally is facing the risk of default and wants protection. Counterparty B is referred to as the protection seller. So he is the one who is willing to assume incremental credit risk in exchange for a periodic payment. So the protection seller receives a periodic payment and guarantees a contingent payment in case of default on a reference asset. So this reference asset can be a corporate, a bond, or any sort of debt that has the risk of default or the risk of a credit event. So if the value of this bond goes down because of a credit event, very important, the value of the bond can go down because interest rates go up. We're not talking about that default. The loss in value because of a credit event is what will be covered by a credit default swap. So if the company goes bankrupt, or for whatever reason this value of this bond goes down because of a credit event, then whatever is the loss in value, let's assume $100 was the value to begin with, and this value becomes $60 or $40 is the loss. Generally, this $40 would be made good by the protection seller to the protection buyer if the reference asset defaults. In lieu of this protection, the protection buyer pays the protection seller a periodic payment, also known as the CDS spread. So this periodic payment could be something like 1% of the notional or 2% of the notional, depending on the probability of default and the loss given default of this reference asset. So the annual payment is referred to as the credit default spread, and provides protection against default on the reference asset. So let's do an example and understand this better. The protection buyer, call it A, enters a 1-year credit default swap on a notional of $100 million worth of 10-year bonds issued by XYZ. The swap entails an annual payment of 50 bips. The bond is called the reference credit asset. At the beginning of the year, A will pay 50 bips or 0.5% of 100 million. So that is the CDS spread that will have to be paid to the protection seller, which comes out to be $500,000. At the end of the year, if the company defaults on this bond and the bond now trades at 40 cents to the dollar, so it was worth $100 to begin with and is now trading at a 60% discount or only worth 40% of its value. The counterparty, that is the protection seller, then has to pay $60 million to A. If A actually held this bond in his portfolio, then the credit default swap provides protection against the credit loss due to default. Now please note, just like regular derivatives, a credit derivative can also either be cash settled or there may be a physical delivery. So in a cash settlement, at default or once the contingent payment is triggered, the protection seller has to pay the loss or simply make good of the loss. So if $100 was the value to begin with or the strike price of the protection, and the final value of the underlying bond is $40, for example, then the protection seller simply pays the buyer the difference, that is equal to $60. So please note that the credit default swap in effect has a payoff similar to a put option. So even if you purchased a put option on a simple derivative, your payoff is K minus S and you have to pay an upfront premium. The only difference is that in the case of credit default swaps, that premium may be an upfront premium or it may be an annual premium called the CDS spread. So there is an agreed upon strike price or the value of the bond that we have agreed on. If the value falls down because of a credit event, so S is lower and this fall is because of a credit event, a credit downgrade, a bankruptcy, or a default of any other sort, then the protection seller will pay $60 and the default ends here. That is, or the CDS ends here. That is, there will be no further payments of 50 bips or these 500,000, and the seller has made good by paying $60 or providing the protection to the buyer. In a physical delivery, the bond is actually exchanged for $100. So if the strike price is $100, the protection buyer will actually sell the bond to the protection seller who will pay $100. So the buyer gets $100 and not $60, but he sells the bond. So the protection seller can now sell this bond in the market for how much? The current price is $40. In both cases, a physical delivery or a cash settlement, the payoff economically remains the same. So the seller eventually has a loss of $60 and the buyer has a gain of $60 because he got $100. Even in this case, in a cash settlement, he gets $60 from the protection seller and he has $40 worth of the bond. In some kind of credit default swaps, there is just a lump sum payment based on some pre-agreed recovery rate. So it's just agreed that if this bond defaults, I will pay you $50, regardless of what the price of the bond is. So in such a case, the payment will simply be the notional multiplied by the recovery rate agreed. So let's say it's 50% or 40%. depending on whether the bond is in default or not. So if I is equal to 0, that means no default. If I is equal to 1, that means the bond is in a default. So payment is just one lump sum number, not depending on the price fall or the final value of the bond. Now, very importantly, a long position in a defaultable bond is economically equivalent to a long position in a default free bond plus a short position in a credit default swap on the same underlying credit. Now please understand that if I purchase a corporate bond that gives me cash flows of $505, this is a corporate bond and it has a yield to maturity of YC, and I have a treasury bond that gives me the exact same cash flows. Which of the two bonds will have a higher yield or a lower price? It will be the corporate bond because there is credit risk. Now, the yield on the corporate bond will be higher than the yield on the treasury bond to the extent of the credit risk of the corporate bond. So what theory argues is that the yield on the corporate bond for the same cash flows is higher than the yield on the treasury bond because of the credit risk. So if I hedge this credit risk by buying a credit default swap or paying a CDS spread, then I have completely hedged my position, because even if the corporate bond defaults, this CDS spread that I'm paying ensures that I'll be made good whatever is the loss. So the yield on the corporate bond should be equal to the yield or the annualized yield on the treasury bond plus the premium on a credit default swap or the credit default swap annual spread that makes sure that the default on the corporate bond is taken care of. So very important questions have come on testing this relationship, or you can say that approximately the yield on the corporate bond minus the yield on the treasury bond, which is otherwise similar in all respects, should be approximately equal to the CDS spread. Now please note that when buying a credit default swap, you need to be careful of the counterparty who is the protection seller. So the counterparty in this case that we are discussing is the protection seller. If the credit rating of the protection seller is not very high, then it is possible that when the reference asset defaults, this counterparty also defaults, thereby not providing the protection that was intended or that you were hoping. So when the reference asset defaults, the counterparty also defaults. That's a risk. So when deciding this credit default swap premium or deciding the spread that you are going to pay, you have to ensure that the credit rating of the protection seller is good, and the spread will increase if the credit rating is high and the correlation of the counterparty with the reference asset. So this is the correlation between the protection seller and the reference asset. So if the default correlation is very high, it's 0.8, that is when the reference asset defaults, your counterparty also tends to default, then I'll be willing to pay a low premium because I know that the protection may not come. Whereas if there is no correlation of default between the seller and the reference asset, then I'll be willing to pay a relatively higher premium, because I know that when my reference asset defaults, it is unlikely that the counterparty will also default. So the spread that you pay depends on the credit rating of the counterparty. The higher the rating, the higher the spread, and depends on the correlation between the seller and the reference asset. If the correlation is low, the spread will be lower. The spread will be higher, my apologies. If the correlation is high, the spread will be lower because it's likely that both of them default together. Now there are two variants of the credit default swap that we need to be aware of. In a first to default swap, from a basket of reference assets, so A, B, C, D are, for example, 4 reference assets, the protection seller will make good for the payment of any of these defaults. So if the first one defaults, let's say B defaults, then whatever is the loss in value, the protection seller will make good and the CDS ceases to exist. So the first of N bonds, whichever it may be. So when the first one defaults, whatever is the loss because of that default, you make good the payment, and that is the end of the swap. In an nth to default swap, you make good the default of the nth instrument. So let's say in a second to default swap. So if the first instrument defaults, there will be no payout. If the second instrument defaults, the payout will be equal to the loss because of the second instrument. So only for the second instrument, whatever is the loss will be made good. So there are many variants that you can construct of the credit default swap. First to default and nth to default are two examples. First, any one defaulting. Nth, the nth bond should default. So third to default means first default doesn't matter, second default doesn't matter. It's only when the third default happens, whatever is the loss because of that third default will be made good by the protection seller. If an investor holds a 5-year IBM bond, it will give him a return very close to the return of the following position. A 5-year IBM credit default swap on which he pays fixed and receives a payment in the event of a default. So let's first depict the payoffs from a 5-year IBM bond. So it will be a fixed inflow and a payment of par value at maturity from the IBM bond, because he is the investor, he holds. Of course, if IBM defaults, there can be a credit loss. So to replicate this position, if he holds a 5-year credit default swap on which he pays fixed and receives a payment in the event of a default, so that's like buying the protection. Now in this case there is a risk of default. Option A protects the risk of default. It is not the correct option. A 5-year IBM credit default swap on which he receives fixed and makes a payment in the event of a default, that is correct. That takes care of the credit risk, or that brings in credit risk into the portfolio that is present in our existing portfolio. However, it doesn't still get us the fixed cash flows. So you buy a position in an otherwise risk-free bond. So hold a 5-year US Treasury bond plus a 5-year credit default swap on which he pays fixed and receives a payment. Again, he has to take the credit risk because the IBM bond has the credit risk and we want to replicate this position. So in which he makes a payment in the event of a default would be the correct answer. So if he takes a treasury bond plus a credit default swap on the IBM reference asset or the reference bond, then it is the same as holding the IBM bond, because even in the IBM bond you get fixed payments and there is risk of credit default. So if I've bought a treasury and I've simultaneously shorted or sold a credit default swap, then it gives me the same payout. A credit default swap is an instrument that can be characterized best as any swap that has one or more parties in default, a swap that can only be valued against non-investment grade debt securities, that's not correct, an option to sell defaulted securities at par value to a third party in exchange for a series of fixed cash flows, that is correct. That is what a credit default swap is, that you can sell it to a third party in case of a default for a series of fixed cash flows. Any swap that defaults to third party guarantors should be a party to the swap file for bankruptcy protection. There's no limitation like this. A portfolio manager holds a default swap to hedge and AA corporate bond position. If the counterparty of the default swap is acquired by the bond issuer, then the default swap increases in value, decreases in value, is unchanged in value. So there is a protection buyer, there is a protection seller, and there is a reference asset, that is the AA bond. Now the counterparty is acquired by the bond issuer, so AA acquires the seller. So you bought protection from the seller on this reference asset, and this reference asset company has acquired. So what will happen, or what will be the worth of this protection now? It will be nothing, as when A defaults, the seller most definitely will be in default, because the seller is a subsidiary now of the counterparty, or it is fully owned by the reference asset. So the swap will decrease in value. A portfolio consists of 100 million asset and a default protection contract on this asset. The probability of default over the next year is 10% for the asset and 20% for the counterparty that wrote the default protection. The joint probability of default for the asset and the contract counterparty is 3%. Estimate the expected loss on this portfolio due to credit defaults over the next year with a 40% recovery rate on the asset and a 0% recovery rate for the counterparty. Now please note that credit loss will only happen in case there is a joint default. So the probability of a joint default is 3%. Rest of the times there is no probability or there is no chance of a loss, because if the counterparty otherwise defaults, it's not a problem. Problem is only if the reference asset also defaults and the counterparty also defaults. So the probability of a joint default is equal to 3%. So 3% of the times there may be a loss, and even if this default happens, the entire 100 million will not be lost, because we may not be getting anything back from the counterparty, but 40% can still be recovered on the asset even if it defaults. So 60% is the loss given default. So the expected loss would be $1.8 million. When an institution has sold exposure to another institution in a credit default swap, it has exchanged the risk of default on the underlying for which of the following? Default risk of the counterparty, default risk of a credit exposure identified by the counterparty, joint risk of default by the counterparty and of the credit exposure identified by the counterparty, that's also not correct, or the joint risk of default by the counterparty and the underlying asset, as we just saw in the previous question. Now, a lot of times in a credit default swap, there may be a confusion as to whether the loss in value was because of a credit event or not. So the value may have come down by 40%, but the protection seller is arguing that this is not a credit event. A rating downgrade is not a credit event, or rating was downgraded by only one agency, the other agency matters, so on and so forth. So in a total return swap, what the protection buyer does is that he swaps the entire returns on the reference asset for a fixed payment to be received from the protection seller. So let's say the protection buyer has a position on a reference bond. Let's say it's a credit risky bond. So whatever is the return on this bond, the positive coupons, any appreciation in value, will be swapped by the protection buyer, that is, will be given by the protection buyer to the protection seller, and in exchange the counterparty or the protection seller will give the protection buyer a fixed rate. So in effect, he has swapped his position in this bond for a fixed rate normally linked to LIBOR. For example, this was a bond A that gave a coupon of 10%, and the protection buyer enters a total rate of return swap where the seller gives the buyer LIBOR plus 2%. Now for the remaining life of the bond, whatever is the return on this bond, the protection buyer will give to the counterparty B. So if the value doesn't change, 10% every year or every quarter, whatever is the period, will be given to the counterparty B in exchange for LIBOR plus 2% that the protection seller will give to the protection buyer. So the protection buyer is no longer invested in bond A for all practical purposes. If bond A has a further capital gains of 2% in 1 year, then counterparty A will actually give 10 plus 2% in exchange for LIBOR plus 2%. So whatever happens to bond B will simply be transferred to counterparty B. If this bond goes down by 5%, for example, counterparty will give back 5% to counterparty A, or counterparty A will only give 10 minus 5%, that is 10% coupon minus 5% loss in capital to counterparty B, and in return receive a fixed rate of LIBOR plus 2% or LIBOR plus 3%, whatever it may be. The important thing here is that the change in value is not dependent on a credit event. The change in value could be because of a market event or because of a credit event, and hence it's referred to as a total return swap. Let's understand with an example. So suppose that a bank has made a 100 million loan to a company XYZ at a fixed rate of 10%. The bank can hedge its exposure by entering a total return swap with counterparty B, whereby it promises to pay the interest on the loan plus the change in market value of the loan. So see, the bank is entering into a total return swap. So whatever is the interest rate on this loan plus the change in value, he will swap for exchange of LIBOR plus 50 bips. If the market value of the loan decreases, then the payment will become negative, providing a hedge for the bank, or the bank will receive money if the loan portfolio actually has a loss because it's a total return swap. So suppose that LIBOR is currently at 9% and that after 1 year the value of the loan drops from $100 million to $95 million. Then the net obligation from bank A would be an outflow of 10% into 100, that is the coupon or the loan payment, so that's what he has to pay. An inflow of 9.5%, that is 9% plus 50 bips that he receives from the counterparty, and another outflow of the change in value. So had this gone to 105, it would have been a actual outflow. The value has actually gone down by 5% or gone down by 5 million. So the protection seller will have to give back 5 million, or the net outflow will only be 10 minus 5, that is 5 million, because there was a 5 million drop in value. So the net receipt will come out to be minus 5 plus 9.5, that is 4.5 million. Remember, in a total return swap, the payment is not contingent on a credit event. In a credit default swap, the payment is contingent on a credit event. What the credit event is has to be decided by the protection seller and protection buyer before entering the agreement. Another way to take a position in the credit risk is by entering credit spread forwards and credit spread options. There is a spot spread and there is a strike spread. So let's say the strike spread is equal to 3%, and the spread is defined as the Z spread or the nominal spread between the yield on the corporate bond and the yield on the treasury bond. If I think the spread will be higher, then I can long a credit spread forward. So at maturity, let's say it's a 3-month contract. After 3 months have passed, if the actual spread is 5%, for instance, then the contingent payment would be the spot spread minus the agreed upon spread into the modified duration. So this modified duration is also agreed upon beforehand, let's say 7 or 10, multiplied by the notional of, let's say, $100 million or $100. If the spread actually ended at 1%, then the long counterparty would have had a loss that is equal to 1% minus 3%. So please remember that the long gains if the spread increases. So please tell me that a long position in a credit spread forward is equal to or is equivalent to what kind of a position on the bond price, or what view is this party taking on the bond price? If the spread increases, the spread will increase when the price of the bond falls. So remember, a long position in a credit spread forward is equal to or is akin to taking a short position in the corporate bond. So if the payment is tied to a bond price, then the payment can be calculated as the yield on the treasury bond plus the agreed upon spread, that is the strike spread, minus the price of the bond calculated using the yield plus the current spread. So if the agreed upon spread is 3% and the current spread is 5%, for instance, that means the agreed upon price was higher and the current price is lower, because current price is being calculated on y plus 5%. Hence, the 5% counterparty wins, or the 5% counterparty will have a payoff. So remember, long position in a credit spread forward is similar to a short position in a bond. If we are using the repricing of the bond to calculate the payoff, then there will be no multiplication with the modified duration, because we are actually calculating the price. This would anyways include the impact of the duration. For a longer duration bond, a 3% change will have a higher impact. For a shorter duration bond, it will have a lower impact. So then we simply multiply it with the notional. We'll understand better with an example. However, please remember this statement depicted in the red. In a credit spread option, it's exactly the same as a forward. However, it's an option and not an obligation. So if the spread did not go down or did not go up, that is, if it went 1%, the payoff will not be negative because I will simply not exercise my option. If the spread became 5%, I will exercise the option. For buying a credit spread option, I will have to pay an upfront premium. A credit spread option has a notional of $100 million with a maturity of 1 year. The underlying security is an 8% 10-year bond issued by the corporation XYZ. The current spread is 150 bips against the 10-year treasuries. The option is a European type with a strike of 160 basis points. Assume that at expiration the treasury yields have moved from 6.5 to 6% and the credit spread has widened to 180 basis points. The price of an 8% 9-year semi-annual bond. So let's assume that this option was on an 8% 9-year semi-annual bond. So remember, the original yields don't matter. So we'll first price the bond at the current spread. So at the current spread, the price of the bond would be calculated with N as 18, I by Y as 6 plus 1.8, that is 7.8 divided by 2, PMT as 8% divided by 2, that is $4, and an fee equal to $100. Compute PV will give us the price of the bond at the current spread, that is 180 bips. The agreed upon spread was 160 bips. So at 160 bips, the price comes out to be 102.574. That means the payoff for the long counterparty, or if he was long a credit spread option, that is essentially short a bond option. So if spread increases beyond 160, he gains. That is, if the price of the bond falls, he gains. So the price of the bond has fallen from an agreed upon price of 102.574 because the agreed upon spread was 160 bips to 101.276 multiplied by a notional of $100 million, that will be 1.297237. If the spread was not on the bond price, rather we had a modified duration based calculation, then again the answer would have been similar but not exactly the same. So the payoff would have been calculated as 1.8% minus 1.6% into the duration, let's say about 7 years, into the notional of $100 million. So this also gives us the approximately the same answer, but that we have to decide beforehand how we will do the calculation. Both the buyer and the seller have to decide on this. Which of the following is a type of credit derivative? A put option on a corporate bond. So please note that it will be a credit derivative if it involves credit risk or a transfer of credit risk. So if I buy a put option on a corporate bond, then yes, I can call it a credit derivative because the price of a corporate bond would be impacted by credit events and my put option can come in the money. A total return swap on a loan portfolio. Yes, this is also a credit risk because The value of a loan portfolio can change because of credit risk and can affect the swap value. A note that pays an enhanced yield in the case of a bond downgrade. This is also a credit derivative because it is based on a credit event, that is a bond downgrade. A put option on an off-the-run treasury bond will not be a credit derivative because there is no credit risk involved, or credit risk doesn't change the value of this instrument at all, because treasury bonds are credit risk free. So 1, 2 and 3 are examples of credit derivatives. Which of the following statements is most correct? Payment in a total return swap is contingent on a future credit event. That is incorrect. Investing in a risky bond is similar to investing in a risk-free bond plus selling a credit default swap. That looks to be correct. However, we'll verify the other answers. In the first to default swap, the default event is a default on 2 or more assets. No, that's wrong. It's the first to default. Payment in a credit swap is contingent only upon the bankruptcy, not necessarily bankruptcy. It has to be any agreed upon or pre-agreed credit event. Statement 2 is correct as we have discussed. A credit spread option has a notional amount of $50 million with a maturity of 1 year. The underlying security is a 10-year semi-annual bond with a 7% coupon and a $1,000 face value. The current spread is 120 bips against 10-year treasuries. The option is a European option with a strike of 130 bips. If at expiration treasury yields have moved from 6% to 6.3% and the credit spread has widened to 150 basis points, what will be the payout to the buyer of this credit spread option? So the payoff is equal to S minus K into the modified duration into the notional. If not, it will be a position on the bond, that is the price on the bond with the yield plus K minus the price with the yield plus the current spread into the notional. So the underlying is a 10-year semi-annual bond with a 7% coupon and expiration is 1 year from now. So 1 year later, this bond will be a 9-year bond, and hence there will be 18 periods remaining till maturity. The PMT would be $3.5. The interest rate that was agreed upon was 6.3 plus the current spread or the strike spread of 1.3 minus, so at maturity the current spread has widened to 150 basis points, so it will be valued at 6.3, that is the treasury yield plus 1.5%. So after 1 year, the time to maturity of the bond is 18 years, or rather 18 periods. The PMT would be 3.5, I by Y would be 7.6 upon 2, that is 3.8. The future value would be $100 and we can compute the PV. This was the price agreed upon minus the current price would be calculated in a similar manner, or the price based on current spreads would be in a similar manner, except I by Y would be equal to 7.8 divided by 2, that is equal to 3.9. So let's solve it. 18 as N, 3.5 as PMT, 3.8 as I by Y, FV as 100, and compute PV comes out to be minus 96.13 or 96.13. We'll store this in the memory register 1. And for the next calculation, we'll just change I by Y to 3.9 and press compute PV again. where the PV comes out to be 94.89. Store this in the memory register 2. So recall 1 minus recall 2. Please note these values need to be positive. So it will be 1.24485 multiplied by the notional of $50 million, or it will be 1.244% rather of $100 face value, which will give the payout as approximately $62242,000, or if we divide it by the face value of the bond, it will be $0.6224 million. That is option C. So this multiplied by the notional, that is 50, divided by 100, because we calculate the change on a 100 face value bond. Bank 1 has made a $200 million loan to a software company at a fixed rate of 12%. The bank wants to hedge its exposure by entering into a total return swap with a counterparty, Interloan Co., in which Bank 1 promises to pay the interest on the loan plus the change in the market value of the loan in exchange for LIBOR plus 40 bips. If after 1 year the market value of the loan has decreased by 1% and LIBOR is 11%, what will be the net obligation of Bank 1? So pretty straightforward. There will be a cash outflow of 12%, but to some extent this will be reduced because 3% the value has gone down. So 12 minus 3 would be the cash outflow, and LIBOR plus 40 or 11.4% will be the cash inflow. It's a total return swap. So I received LIBOR plus a reference rate and I pay whatever is the payoff on the loan portfolio. So 12% is the interest. If there would have been a 3% gain, I would have had to pay 3% extra, but there was a 3% loss. So it will be a net inflow of 2.4%, that is 11.4 minus 9, into a notional of $200 million, or a net receipt of $4.8 million. Which of the following transactions could be entered into in order to decrease credit risk with a specific counterparty? So I want to decrease the credit risk of the counterparty A. That means when the value of counterparty A falls because of a credit event, I should gain. So if I buy a call option on the counterparty A's common stock, I don't gain, because a long call option will gain only when the stock goes up. I want to gain when the stock falls. Similarly, buying a put option would help, but selling a put option would lose money if the stock falls. If the stock falls, the buyer will come in the money and I'll have to pay him. So I want to gain when the stock falls because I want to decrease the credit risk. Going long the shares won't help. Going short the shares of the counterparty is a good option if you want to hedge your credit risk, because if a credit event plays out, the value of the stock will fall and hence you will gain. The widget company has outstanding debt of 3 different maturities as outlined in the table. So the debt with a 1-year maturity has a price of $100 and a coupon of 7%. Corresponding US Treasury bonds also have a price of $100 even though they pay a coupon of 6%. So the spread is around 1%. 5-year bonds pay a coupon of 8.5% and still have a price of $100. 5-year Treasury bonds pay a coupon of 6.5% and have a price of $100. 10-year bonds pay 9.5% and have a price of $100, so on and so forth. All widget code debt ranks pari passu. That is, if there is a default, default will be for all maturities. Default will not be selectively on the 1 year or the 5 year. All its debt contains cross default provisions and the recovery value for each bond is $20. The correct price for a 1 year credit default swap with the widget co 9.5% 10-year bond as a reference asset is. Now we've studied that the yield on the corporate bond is equal to the yield on the treasury bond plus the spread on the credit default swap. So using this equation, what should be the answer to this question? Now please note, if the question asked the price of a 5-year credit default swap, then this yield or this annualized yield represents some risk for the 5-year default. If you are asked the probability of default in 1 year, because you are pricing a 1-year credit default swap, that is, you want to hold this 9.5% bond, it may be a 10-year bond, but you want to hold it for 1 year and then sell it off. So you are interested in buying a 1-year credit default swap, or you just want to ensure that if in this year the bond defaults, then the payment should be made up for. The 1-year probability of default is best given by the 1-year bond. So the 1-year bond has an additional yield of 1%, implying a credit default swap premium of 1%. Please note, if the 1-year defaults, the 10-year automatically defaults. Or if the 10-year defaults, the 1 year is also in default. So probability of default on the 1-year bond will be the same as the probability of default of the 5-year or the 10-year in 1 year. And that price is 1%. If it was a 10-year credit default swap whose premium we were asked, my apologies, not 5 year, 10 years, then we would be interested, or we would have priced it at 2.5%. But he's asking only for a 1-year credit default swap because he wants to hedge against the loss for 1 year, even though it may be a 10-year bond. So the 1-year probability of default is best given by the 1-year maturity, or there would be a spread of 1% and not 2.5%. This is a good trick question. So it's not just enough to know the concept. You may still have to exercise a lot of your brain on the exam. So make sure you practice as many questions as you can. Similarly, please try to attempt this question. Answer comes out to be $1.02 million. So we'll continue our discussion on credit derivatives, structured products, credit-linked notes, collateralized debt obligations, very important concepts in the coming reviews. In the meantime, make sure that you revise the concepts on default swaps, total return swaps, and you do many questions to understand the concepts. Thanks a lot, and see you next time.